Howdy traders, Mark here with Flipside Trading. It is Sunday, May 10th, and another issue of On the Brink. And today we're going to talk about the markets grinding higher into options expiration. This is a monthly options expiration week. We'll look at our trends and higher highs, higher lows, also our dashboard. And so we've triggered some extra pieces I think that'll take us to some milestone levels. But more importantly, today is Mother's Day. So happy Mother's Day to everybody out there. And just a little, we're a little bit late today because we've been out and about. And let's see, you can see here that the family's out on a hike up at the Poudre Canyon. This is my younger son, Tedesse, Trek, and of course my lovely wife. Does a fantastic job herding us boys, keeping us in line. And one of the great things we got to see is this whole herd of bighorn sheep. And of course, my son, being the comedian that he is, waits to another group of gawkers, come up and deadpans. Hey, I'd never seen such a large number of unicorns all in one space. My wife just rolls her eyes and definitely moves on. So anyway, a great day and fun times. Always good to balance work and life. And I hope all you guys had a fantastic weekend and a fantastic Mother's Day. So let's get back to the charts and see where we're going. Here we are on the SPX. This is the cash, the S&P 500. This is the daily. Remember, we talked about this whole idea of higher highs, higher lows last weekend, continuing trend. And we said that we did expect a little bit of a pullback. Yeah, let's get the right arrow here. Right down here, we did. We came all the way to 21 EMA, and we said if that didn't hold, and if we broke this low, then we would have a trend change and a change in overall sentiment of the market. But that held. There's also confluence here at the 50% retracement, and we're starting to move up, and right here we're at the 618. Now, given this is option expiration, we have this probability and this tendency that the market tends to grind higher. It's just it's not a given, but it's a very high probability. Well, the other key thing is that we have this huge round number right here, right? This 3,000, which really is in confluence with the 200-day moving average. So I'm definitely expecting and would not be surprised. As a matter of fact, I'm going to go ahead and probably do some type of a call spread in the SPX and or the SPY, thinking that for the end of the week we're going to get up to 3,000. So that's definitely on the ticket. And I think that if we look at the other indices really quick, if we look at the NASDAQ, we have kind of the same thing, right? We have this whole idea of, again, higher highs and higher lows, right? We came down, we pulled back here. And now we're breaking through even the 718. But the key thing is, if we break this 718 right here, I think that this gap closure is a very powerful magnet, and it's also a round number, right? 9,400. So you have the SPX at 3,000, you have the NASDAQ at 9,400, and if we go to the rut, we have kind of that same deal here, right? We can see the rut potentially coming up at least into this area on the gap, and that is also 1400, again based on higher highs, higher lows within the channel. So all three indices are really kind of pushing in that direction. And so we're asking ourselves logically, why is this happening? Why are we doing this when we had the highest unemployment numbers, 22%? We have over 33 million people unemployed. COVID-19 is showing some signs of leveling off, but we're not sure. So let's go back to some of our discussions that we had last week, and we'll go back to the PowerPoint here. And so let's just bop off and quickly review. And we'll go ahead and put us in presenter mode here, and then we're going to switch that around to give us the great screen. And basically, one of the things that we talked about, even though we have all these things going on the backside, right? The China tensions, they're still being played, but I don't think anyone's taking them too seriously. This whole New World model, the question really becomes is not how high the unemployment numbers are going to go or how many people are actually filing for unemployment conditions. It's how long, right? That's the key. And right now, I think what we have is this bridge, if you will. And this bridge is given to us by the Fed, basically, printing money. And as long as they print money, and if they can print money long enough to give us a bridge to open the economy, then I think that things will kind of stabilize and move forward. so that's the question. Obviously, at some point in time, the Fed can't print any more money, and then we're going to have to face the reality. But uh, the Fed is still, doing a whole bunch of quantitative easing, right? They're still buying the MBS, the mortgage-backed securities, and the high-yield bonds. And so there is no risk in the market, and we'll take a look at a chart that shows that in a second. So given that's happening, then let's take a look at what we mean. If there's no risk, well, and here it is, right? Here's the Fed's balance sheet, right? We're still buying, mortgage-backed securities. We're huge on the repo, and we're huge on the high-yield bonds, and that's going up. And what's the VIX doing? Well, the VIX is going straight down, right? Opposite directions. Remember, the VIX is our fear sentiment indicator, and it's showing that people are not buying near-term puts, out in the money to provide protection. And they're not doing that because of the Fed. And so if that's the case, based on what we saw, I think there's a really good case for the market to continue to these high round numbers and these high moving averages. The index closing the gap, the SPX going to 3,000, right? And the RUT closing the gap as well. So there's some, and let's look at that again, and one more thing on our dashboard. So let's escape out of here, and let's go back to our stock charts dashboard. So remember, we talked about, advanced decline, and we said when the advanced decline, right, breaks the Kelter channel, which we're seeing right here, we have a propensity to go higher. And so that is giving us an indication that that 3,000 level is definitely in play. I'm not guaranteeing it. No one can guarantee the market, but I think that's a high probability fashion where it's going to go. We take a look here at our breadth and the 50-day moving average. We talked about it last time. We talked about, when we're here, we had this kind of, a little bit of a push down, but we got the hook up. So now we're kind of back into this higher high, higher low trend on, the advanced decline line on the breadth breaking over, the 50-day EMA. And of course, right, you have your higher high, higher lows here on the SPX. And we'll continue a little further down, and we'll talk about our unbalanced volume, right? We're over here, at least on the 50. We haven't quite got what we want on 200. That's always a little bit more lagging, but our unbalanced volume indicator has shown that we have definitely come up and over, right, that 50 EMA, again, pointing higher, right, in the near term. Okay, we're only looking at about a week at this point in time. So what else do we have? Same thing, MACD, all right? Potentially the MACD, if we were going to go lower, right? If we're going to put in a lower low, then what we would have seen is the MACD here. It kind of had this small inflection point. If it crossed, that would have said, okay, it would have been another indicator supporting sign of a sentiment that the market is going lower, but it didn't. It basically came back to the signal line and it bounced higher, right? So it's putting us again into at least the near term, maintaining of that bullish channel. And let's see what else we want to take a look at. Let's leave the world out of it today. Let's kind of move forward. We talked about the VIX, right, in another way, but you can see the VIX here is moving down, right? This is our fear indicator. No one's buying protection, at this juncture. And I really wanted to get to, the high yield bonds, they're not really moving a lot. And okay, here's my thought. Here's why. Basically, if you happen to remember, right here is when the Fed announced that they were going to buy high yield bonds, and we got this huge spike. And so what's happening is that the hedge funds are getting this money basically from the repo. And what they're trying to do is they're trying to front run the Fed secondarily again and buy high yield bonds, okay, in order to push the price higher so that the Fed will be the buyer and therefore they're going to make a profit. And I think the Fed's, as much as you want to say about them, I think they understand those type of dynamics. So they're not kind of rushing in at this juncture as long as they're seeing there's no need, okay, to make it, to save this market, right? The market itself is being pushed up by the hedge funds based upon the money that the Fed's already given them. So there's no need to buy them, I think, at this point. So that's why you're seeing this move at a little bit slower pace. And then Okay, unemployment, we talked about it. Yes, it's a total all-time highs, but again, it's how long, not how high. And I want to go to this last page. Okay, so look, we've had all these different indicators. We said, look, they're all pointing bullish and upward. Now, I do not want to give the impression that this is a total V bottom and that we're out of the woods, because I want to go back to Japan, because Japan is the model that we're kind of tenuously following at this juncture, right? Where the Fed comes in and, prints money and buys the market, and therefore, buys support. If you look here, where really Japan ran into this is kind of where we are right now relative to Japan. And you saw that. And this is a monthly chart, okay? So this may take a while, but they did have this whole secondary pullback here. Now, the difference is, does that mean that it's going to happen here in the US? The answer is maybe, right? We don't know. I'm not going to prognosticate that. I'm saying it's definite possibility. And that since it is a possibility, I would kind of take the market up incrementally, 1-2 weeks at a time, instead of going full boat and thinking that we're going to go back to all-time highs. I think the difference is between 2008 and when Japan started facing their crisis back in 1989 and starting here in 1990, is that, number one, Japan has showed us the way. Number two, we broke the ice, should we say, and tore the seal off in our markets in 2008 with the whole quantitative easing thing. And we've actually accelerated that, right here in 2020, with this unprecedented, kind of $9 trillion that we're pumping into the market. So the question is, have we pumped in enough money, should say enough large volume of money in a fast enough time to prevent this, right? To prevent this push down? I don't know. We're going to have to watch the market for that. I think potentially, again, it talks about how long that the economy is going to be shut down, because there could be kind of, after the employment benefits, start to slow down a little bit, the reality hits that everyone is not going to be rehired, right? You're already seeing, a lot of the large S&P 500 companies are saying they're going to cut somewhere between 10 and 20% of their workforces. And that'll take, 2, 3, 4 months, I think, to materialize before this, say, second leg down, may happen. The other thing is because we have all this money in and these supports, we kind of look at consumer credit, and we're not seeing, the rate of defaults. And the rate of defaults is because those defaults take 60 to 90 days. And if you really take a look at, our market and where COVID came into play, and let me go back to the previous real quick, and we'll scroll all the way down just to get to the S&P charts. We have it. Is that, we're kind of in this March time frame. So, 90 days out, we really haven't hit that. And that's just when, if you say, we should start seeing the defaults hit. So again, if we're going to have a second leg down, I think it'll be, at that point in time, unless we can get the economy back to work. So it's still going to be pushed out a little bit. All right, guys, you can see what we have here, right? We're definitely going to be cautiously long, into that 3,000 level with the SPX. We're going to be buying some SPX call spreads, this week. It's definitely something to think about. Remember, this is not a recommendation. This is education. Have a great week. Hope spring has sprung where you guys are. Enjoy the rest of the weekend. And as always, we'll catch you on the flip side. Take care.